Hello, today the Governor and the Board met and they've kept interest rates on hold. Now this was widely anticipated. The facts are that a 2% cash rate is a historical low level. And if we were to actually move rates further down, which we do have capacity to do if you look at the minutes, they are saying we have the capacity there, but in reality they would be emergency settings. Now the RBA has recently adjusted our GDP forecast, which means our growth, how the economy is growing, once again. Now this is the fourth time they've made adjustments. So the reality of the move on the cash rate, and certainly following the federal government's budget release in May, has said we need to get on with business. Now what does that mean in terms of getting on with business? Well, basically you saw it's the have a go budget. Now the have a go means there's a lot of focus on small business and certainly a lot of CapEx expenditure. So we saw them introduce a $20,000 CapEx expenditure for this financial year. So that's about getting out and spending. In addition to that, locally we saw a real bounce in consumer sentiment. In fact, it was 16 months high that we've actually seen in regards to that. So it's been a positive outcome or a positive read around what's the initiatives inside the budget for consumers. Now, consumers are going to have to lead this impetus, this momentum into getting the economy moving forward, because we do know, unfortunately, we are still struggling with the collapse of the CapEx expenditure that's occurring in the mining sector. We're not seeing spending on infrastructure, and we're certainly not seeing at this stage that spend inside business. We're not seeing confidence yet in that space. Now, if consumer confidence leads us to a retail spending increase, and we've obviously seen it in the housing market in regards to a very, very healthy housing market in terms of approvals, well, we need that to do some more heavy lifting. But we also need the state governments to start spending on infrastructure. It's so important we get that infrastructure moving because it increases productivity and it gives us longevity in what has been an incredible run in terms of positive economic growth for the past 24 years, almost coming into 25 years. Now, that being said, I want to focus very heavily on the property market at the moment. We're seeing APRA. Now, for those who don't understand who APRA are, they're basically the regulatory authority that looks after the lending sector. Now, their job is to try and keep it healthy. By that, they mean they want to keep comfortable reserves. Because if we have a collapse in the financial services sector, basically you saw what happened in the GFC in America. It's a crazy situation where our economy would fall into a deep recession, probably even a depression. So on one hand, APRA are basically doing some smart things. Now, the smart thing they are doing is they've basically said to lenders, look, we want you to increase your assessment rates, which is going to reduce borrowing power. That's good because what we're seeing in the Sydney market is pure speculation at the moment. So we've gone past what is fair market value and now we're getting into speculative buying. Fear of missing out is really creating a frenzy of buying in that market, and there are going to be a lot of people who buy property in today's value terms, and that in several years' time from now, those properties will be worth exactly the same, if not lower, than what they've paid today. So I'm very concerned about the activity that's happening in the new established and off the plan space. There are going to be people who are going to lose a lot of money once we see those properties coming online in 2016, 2017, 2018. Okay, so back to APRA. Now what I'm comfortable with is they've basically changed the assessment rate, which means borrowing power is a little bit restricted. That's a good thing to do. But the silly stuff they're doing, some lenders are now dropping LVRs. Some lenders are changing other aspects around servicing for negative gearing, and also the reduction in terms of how much rent you can use to assist with your servicing. That's dumb. Okay, and the reason why it's dumb is because the only market that's thriving is Sydney. Melbourne is not far behind it. Emotional buyers are buying stuff in eastern areas which are at a hugely increased value. So I suspect we're going to see some correction in the emotional buying area. If you're taking long-term view, that's okay. So you want to be very clear about the types of assets you're buying for investment in a marketplace like Sydney and Melbourne at the moment. But the other markets are lagging. So what I don't like about what APRA is doing, putting an 80% ceiling on lending, or influencing the banks to make those types of decisions, is going to restrict activity. I mean, investment activity It creates direct jobs and it creates indirect jobs. Once those houses are built, people live in an area, they've got to furnish the property. That type of momentum is going to be important. I get it. I get that Sydney's a very, very hot market at the moment and it's overdone, it's cooked itself. So I can understand why we're making some of these changes and I support some of them. But the whole marketplace, Western Australia, Darwin are on the decline, Canberra as well as soft. So we don't want to be restricting those particular markets. So come back, make a cap on the assessment rate, but keep all the other aspects of terms of serviceability and credit policy where they were. So I want to wrap up by just saying the property market as it sits right now, with these historical low interest rates, if you've been watching my videos for a long time, you would understand that I've been critical of any type of speculative investing. Okay, so you've got to be smart about where you're investing. And in fact, you've got to be investing, you've got to be a borderless investor, meaning that you shouldn't be investing in your own backyard because it's definitely run too much in the Sydney market. You need to be a borderless investor and look at other opportunities in those particular markets. That's my big message for this video. Also, to those people who gave me some well wishes, I've been unwell of late. I've had an operation on my back, and as you can see, I'm standing up and I'm in my recovery phase of that operation. So thank you very much for those people who sent me all those get well soon wishes. I'm improving and I'll hopefully be back to full health really soon. Thanks very much for watching.